The yield curve is often described as the bond market's crystal ball. It reflects expectations for inflation, growth, and central bank policy. In normal environments, the curve slopes upwards because investors demand compensation for time, uncertainty, and inflation risk. But in stress periods, or when the market's view of policy diverges from economic reality, that smooth curve can twist, kink, or outright invert. These dislocations are not anomalies, they're signals, and if you know how to read them, they can reveal what the market is truly worried about. Let's start with the basic mechanics of why dislocations happen. The front end of the curve, say maturities from 3 months to 2 years, is highly sensitive to central bank policy. When a central bank hikes aggressively, the front end reprices almost instantly. The long end, however, is driven by slower moving forces, long-term inflation expectations, term premium, pension fund demand, global capital flows, and hedging activity. So when the front end is responding to a policy shock, but the long end is anchored by structural demand or global risk-off sentiment, the curve can invert dramatically. This is exactly why yield curve inversions are not always a sign of imminent recession. They're often a sign of policy credibility. If the market believes the central bank will eventually control inflation, long-term yields can fall even when short-term rates rise. The curve inverts not because the economy is collapsing, but because investors trust the policy path. Another driver of dislocations is liquidity fragmentation. In stressed markets, certain maturities become crowded as traders hedge futures, options, or swap exposures in specific tenor points. When flow clusters around the 5-year or 10-year sector, the curve can develop unnatural kinks that have little to do with fundamentals and everything to do with the dealer balance sheet constraints. These distortions create meaningful opportunities. Relative value traders look for steepeners, flatteners, or butterfly trades, structures that isolate specific curve segments that are mispriced relative to each other. Corporate treasurers also use curve dislocations strategically. Inversions can create rare moments where issuing long-term fixed debt becomes cheaper relative to short-term borrowing. Even if the absolute yield is high, the relative pricing can lock in significant long-term savings. The key takeaway is simple. Yield curve dislocations are windows into the market's collective psychology. They reflect the tension between policy, liquidity, and long-term expectations, and they often flash warnings long before traditional indicators do so. For investors, traders, and corporate finance leaders, reading these signals is essential. The curve isn't broken when it inverts, it's communicating.